Welcome to this edition of the IBKR podcast. Now, stocks and bonds both enjoyed a more positive tone following Fed Chief Jerome Powell's Jackson Hole speech last week, and the interest rate market is now looking for 2 cuts starting in September. Joining me to discuss how that might affect the economy is Interactive Brokers senior economist Jose Torres. How are you, Jose?
Doing great, Andrew. Thanks for having me. How are you?
Doing okay, thank you. I had the pleasure of interviewing Steve Sosnick earlier today, and we talked all about the Powell meeting, and that podcast is now live. And we're recording this Monday afternoon, so this podcast should be going out Tuesday morning. Jose, Donald Trump has been screaming at Jerome Powell about the need for interest rate cuts. Which one of them has most sympathy from you?
At this juncture, it is the president. I think for a while, we've waited several months, several quarters already for tariff-fueled inflation to show up in the numbers. And we haven't really seen a meaningful impact from those tariffs. In fact, lately, we've had inflation start to come in a little hotter, modestly hotter. And Andrew, it's really been the services. It hasn't been the goods at all. And I think the reason why you're seeing some services inflation is because we're starting to get into an economic reacceleration here. Folks are now more confident about the path ahead. In the first half, there were a lot of worries that levies would be way too elevated and that would cause a recession or cause a slowdown, or we'd have significant job losses. Now in the second half of the year, you have a much more confident consumer. We're seeing services inflation is really driven at this point by servicers being able to raise their prices. So two of the main categories where we've seen that pricing power exhibited has been with the airlines. The fares have been going up significantly. We saw that in the last CPI and PPI for the month of July to start the second half. So that's a big discretionary category. Airlines are raising prices in a low oil cost environment. It's driven by consumers wanting to get out there and embarking on discretionary categories. Second one has been brokerage firms and advisory houses. They've been able to charge more, bring in more revenue. And part of that is the animal spirits in markets, rising asset prices, and the exuberance that we've been seeing on Wall Street, not just in equities, but also in rates. We have a pretty strong treasury rally on a year-to-date basis on both the short end and the long end. Back to the question, why should the Fed reduce rates 25 basis points? Inflation is in the mid-twos. We haven't seen the tariff pressure from goods reflected yet. Fed funds is at an upper end range of 450 with inflation in the mid-twos. The economy overall is doing great, but we have a lot of pockets that, when you look under the hood, are particularly weak. Number one is real estate. Just awful. This morning, Monday, August 25th, we got new home sales. Terrible. Inventories are through the roof. Pricing power is in the tubes, in the basement. Builders are offering concessions. They're offering price discounts. Andrew, do you know that prices are down from 2022? When you look at the average and median, and in certain months, we'd have to average it out, but just from a first glimpse, certain months in 2022 had higher new home prices than they do today in 2025, 3 years later. So that's certainly an area that could benefit from lighter borrowing costs. Now, we know that the Fed controls the short end, but if they bring down the short end, then you could have some confidence on inflation expectations that's going to work its way down on the long end as well. Also, credit availability. When the Fed reduces on the short end, it does make credit more available and gives folks more of an opportunity to get into the real estate sector. Manufacturing, doing great from an investment perspective, capital expenditures, dollars pouring in, like the president says. But from a ordering perspective, it has been really weak for all year, really. Now, we got a report last week from S&P Global, formerly IHS Markit, PMI manufacturing, that showed a significant surge in ordering for this month, August. We have to see that data is volatile, and a lot of times similar to ADP and BLS, S&P Global and ISM manufacturing, sometimes they're pointing in way different directions. So we got to wait and see. But those are two areas that can benefit significantly from interest rate cuts: real estate and housing. And then hiring. We don't have that cyclical hiring strength. We haven't had it for a long time. We've had the gains in this year for the Trump administration have been derived from private education and health services. Last few years under the Biden administration, you had those two leading, but you also had government. Of course, President Trump wants to reduce the federal government payroll headcounts, and that's why that category isn't offering a tailwind anymore. So we need more of the cyclical areas to start helping there as well. Final point, what's also hampering real estate as well as hiring and manufacturing to a different extent is immigration. We have immigration restrictiveness right now. A lot of those immigrants that were coming in, they were working higher income blue collar jobs like construction, air conditioning, plumbing, those kinds of jobs. And they bring demand into the rental market. They eventually buy homes, right? And from a demographic perspective, they have more children, they have more births. So that offered a tailwind to the housing sector. Andrew, we got the existing home sales report last week. Prices year over year grew 0.2%. We are on the verge of going negative, falling home prices. New homes were already there, but existing is the much more significant market. That's where most of Americans' equity is. And that's a number that's watched a lot more. That number is on the verge of going negative. So I think that the Fed, with inflation in the mid-twos, should get started. Market thinks they're going to get started in September. I think they should have gotten started in June or July, and then see what happens with some quarter point reductions, because that's going to reignite economic growth, provide some stimulus to the economy, and help all those areas that I just mentioned that could use a little boost.
So as and when, assuming the Fed does start easing policy, Jose, how will investors gauge the success of monetary policy easing?
I think that they're going to gauge the success by stocks and what the stock performance is. Of course, that's what most people care about these days in the Wall Street circles, is what the stocks are doing, but also by inflation, right? Can you cut and keep inflation below 3%, keep it in the mid-twos? During the first Trump administration, we saw inflation get up to 3%, roughly 2.9 and change, only to retreat back to the mid-twos. Similar story back then. You had pricing power. You had servicers able to increase prices on consumers because growth was so buoyant. We had some quarters back then where growth ran in excess of 4%. So I think if you have stocks continuing going higher and you have inflation remaining in the mid-twos, that is a success. But here's the icing on the cake. Folks, the Russell 2000 is still below its 2021 highs, or November 2021. It's been almost 4 years, more than 4.5 years since then. We need a broader rally. We need more participation. These 2 years of returns in excess of 20% have been terrific. We're not going to complain about that. But they've also opened the door to some vulnerabilities, namely concentration risk. We could use a broader rally, and rate cuts will certainly help. In fact, during Jackson Hole, small caps led that rally. It was up 4%. The IWM, the Russell 2000 ETF, was up 4% during that Jackson Hole speech because of monetary policy easing prospects. Other cyclical sectors in the large cap space that'll benefit from a rate cut are going to be industrials, materials, real estate, definitely, technology, consumer discretionary, energy, and communication services.
Excellent. Jose Torres, Senior Economist here at Interactive Brokers. Thank you for taking the time to join me today.
Thank you, Andrew. Great to see you, and looking forward to next time.
All right. And don't forget, if you enjoyed today's edition, please remember to subscribe wherever you download your podcasts from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.